In this video, you're going to see how you can trade options weekly and create cash flow in your stock portfolio. By the end of the video, you will have actionable steps that you can use to replicate this strategy with your own trading. The first thing you want to do when trading options with a weekly expiration date is find a technical setup that you like. This could be bearish, this could be bullish, or even neutral. For this example, we're going to go with a bullish setup that we like to have, and for that, we're going to TradingView. When I'm looking for a bullish setup on a chart like Apple's here, what I want to see first is the stock price moving above a key moving average or technical level, like the 50-day moving average and definitely above the 200-day moving average shown in red right there. That's number one. Number two, you want to have an increase in volume at the bottom right there. These volume bars are increasing, meaning that there's more buyers coming into the market and pushing the price of this stock higher. That's great. That's number two. And number three, we've got our friend RSI down here at the bottom. We want this to be above 50 and trending as well upwards in that positive direction. If I have those three things, that's a good indicator to me that this is a bullish setup, and I can go into the options chain and see what Apple's going to pay me for these options trades. So once inside your trading platform, mine happens to be Interactive Brokers, navigate to your options chart for the stock. I'm going to go to Apple, and I'm going to make sure that we are on the weekly expirations here. I can only see a few right now, which makes me believe that weeklies and quarterlies aren't toggled on. Let's toggle those on and then see November 10th is the end of this week, which is 4 days away. So we're going to go out one more week in time, make it a full week and a couple of days here for this example. Now, here's what you need to remember. When you're trading weekly options, I do not recommend going with the buying of a call strategy. Why? Because when you're trading the options weekly, there's a limited amount of time for the stock to move. If it doesn't move right away, your position will be getting crushed by what's known as time decay or theta. If you buy an option that's a call option for $100 and you've spent $100 into the trade, if the stock does not move up immediately with a 1 week expiration date, every single almost hour that goes by, that $100 is getting worth less. It's going from 100 to 95 to 90 to 80, all the way down as time chips away because there's so few days for the stock to move. Even if on the first day it doesn't move at all and then goes on a bit of a heater on day two, you still may be in a negative position because the theta decay is so great at that time. So we don't want to be buying and working against theta in this example. We want to be selling and taking advantage of theta, getting paid for that time decay. That's why I love to sell options when we're looking at weekly expirations. And you can do this with a huge account, which is going to show you in step one here, or with a very small account in step two. I'm going to show you both coming up right now. So now that we know we're going to be selling put options, what we want to do is then go pick the right strike price based on our risk tolerance. And our risk tolerance is made up of two things. Number one, it's made up of a technical level on the chart. If we think that Apple's going to stay above 175 on our chart, we can be confident that selling a put option here at 175 at the strike is a safe play. What this means is that if we do have to end up buying Apple, we would do so at 175, and we get paid around $1.06 per share times 100 shares. For every contract, there's 100 shares. So $106 to buy Apple at 175 per share. So we'd spend about $17,500 to buy. We get paid about $106 to do so. Not a bad trade. Pretty good return on that one. Let's just hop into the chart one more time to make sure that 175 is a good technical level. And so this yellow line here represents Apple at 175. And you can see that there's been some action around there in the past few months. It's kind of flirted with that line a little bit. So maybe we want to go a little bit further out, a little bit further lower, and drop this down to 172 or even greater down to 170 and sell there and say, hey, if Apple stock does drop back to this level right here, we're okay buying it at 170 and getting paid to do so with a little bit of buffer. If it doesn't, we get paid that premium and we don't buy any stocks at all. So the 170 level, we're in here at 170. We're getting paid about 40 cents right there. So maybe not the most amount of cash. Maybe we want to go in the middle and strike it at 172.5 and look to sell this option right there. What we need to do next then is to confirm that if the delta is an acceptable measure of risk. For this trade, if I was to sell this 172.5 put on Apple, I would get paid the middle between 63 and 65. So let's call it $64, right? For 100 shares. Not a bad return, day at the office. And I would have a delta there of 162, meaning I have a 16% chance of having to buy Apple when I make this trade right now. This represents a very small amount of risk of having to put my $17,000 in play. I get a decent return of $64, not earth-shattering, but when you do this over and over again, week after week, $60 a week isn't a bad return if you annualize it out over the course of a full year. It actually ends up being about $3,300 if you do this trade once a week, every week for 52 weeks of the year. Not a bad return within a capital investment of $17,000. It's about 18% on the year. Pretty good, right? So you could do that. You could also select a different strike price and go a little bit more risk on and get paid a little bit more. Now I see a lot of traders using the 16% or 16 to 20% delta for this strategy, which is great, totally risk off. However, when you think about how little time there is for the stock price to move, it could warrant getting a bit more aggressive and going up one more layer to 175 and potentially getting paid $40 more to sell that put at 175 if you're okay with a 25% chance of owning Apple shares at this strike price. The choice is yours, but that's how you can do it with a large scale account. About $17,000 of capital to make this trade once, and to scale it up from there just takes more and more dough. For the accounts that are smaller and want to kind of preserve their capital, not put on such large positions, you can still profit when you're looking at weekly options. Here's how. Now, if you have a smaller account size, you can do this instead of selling puts. You can sell a put and then buy a call, known as a credit spread. You are still getting some profit, but you're also protecting your downside risk, and you're also not including so much capital into your trade. To do this, you would want to sell that 175 put. I'm going to turn Strategy Builder on right there to do that. And then we're going to bring this down and just go sell this 175 put, just like we did before, same kind of thing. If we were to do this trade, that would be the exact same trade. But now we want to then go and buy a put option as well to cover our downside risk. So I would go down to the 170 level because there's a lot of option volume in here as well. And volume is an interesting thing for options traders. Generally, you want to be picking areas with the higher numbers of volume and open interest because there are more liquidity or more trades in that strike price, meaning when you go to close your position, this bid-ask spread is going to be a little bit tighter. It's going to be a little bit easier to get in or out of your position because there is more volume and more open interest in that strike price. I'm going to click the 170 here and buy this put. We're going to buy those. Now we can see down here, we have a bull put spread down here, and that's going to allow us to capture this profit here by selling one put. We're going to make that between that 105, 107, so call it 106. And then we buy a put. We have to pay a little bit of money to do that. So we're going to then buy this put for around, let's call it 40 cents, which means we're going to go 106 minus 40, which leaves us roughly $66 of profit. And it's going to show up in the credit down here, right around the $64 area right there. We get a credit, we submit that order. And so in this option, when you're using the credit spread, your overall input into the trade is only about $500 USD versus the $1,700 when you're trading the puts by themselves. What this means is you get a smaller return relative to the puts that you're going to trade, but you have limited risk in the trade. And there's still a great winning percentage, around 80% in this example, when you're using the credit spread. Why don't people use these all the time instead of using the big puts? It's because they can't control the shares. Some people want to collect the dividends by actually owning the shares themselves. Some people don't like monitoring their positions all the time, which you have to do a little bit more of when you're using credit spreads or more advanced combination options trades versus just selling or buying puts and calls. The other thing is that people sometimes just don't know how to use credit spreads properly to do their trading. And it's a little bit more of a fine kind of detail to do this, but it's great for small account traders. And now you know how to set one up, you know what to look for when you're looking at the technical setup for a bullish run, and you know how to trade options two different ways for two different account sizes when you're looking at weekly expiration. If you want to know more about how credit spreads work in depth and how you can use them to make even more cash for your portfolio, I recommend you subscribe to my channel here and check this out.